Good evening, everyone. Good evening, Yogesh. Good evening, Jyoti. Yes, welcome to the session. So, what we are going to do today, we are going to start with a new topic, which is the assessment of various entities. Fine. Now, here, what we are going to cover, students, is basically we are going to cover the sections in respect of the companies, the partnership firm, AOP, BOI. So all of these sections that we are going to cover, in that we are going to bifurcate into different sections this particular chapter. So first, we will be discussing about the private limited entities, individuals, partnership firms, AOP, BOI, HUFs. So different cooperative society, mutual concerns, all of these we are going to do one by one. Fine. So let us quickly get started with it. So this chapter will be covering for you the assessment in respect of individuals, companies, partnership firms, AOP, BOI, cooperative society, HUF. Fine. So first of all, we will quickly talk about, good evening, Samnithan. We will quickly talk about the individuals and then we will move towards the company. Now, we have done about the individuals, and you are going to help me recap about the taxability for the individuals. Okay, so first and foremost thing with respect to the individuals that we are going to talk about in the assessment of various entities is the taxation. So, how are the individuals taxed? Yes, we have done that in the basic concept class also, students. Taxation of individuals. Yes, 115 BAC Jyoti. Yes, that's right. So, individuals, HUF, AOP, other than the cooperative society or BOI, artificial juridical person, they are governed under the default tax regime, yes, Jyoti, correctly, which is under 115 BAC. So, who all are covered under 115 BAC? If we go back to our basic concept class, and if we look at the individuals again, yes. So, what is the default tax regime? For individual, HUF, AOP, BOI, artificial juridical person, not the cooperative society, default tax is 115 BAC. And these are your tax slabs, isn't it? So, what are the tax slabs? From the this particular year, the tax slabs are as this under. Yes or no? What are the tax rates? Yes. Quickly.
Under default regime 115 BAC, for every increment in 4 lakhs, there will be increment in 5% of the tax rate, ma'am.
Correct. So, for the default tax regime, you have the 115 BAC. So there you are starting with this particular first 4 lakh rupees nil. Then you have the tax rate, which is basically going after every 4 lakh, the tax rate is increasing by this particular percentage of 5%. Yes or no? So this is the default tax regime 115 BAC. And what are the Disallowed exemptions under this?
LTA, HRA, uh, LTA, HRA, any 1014, any special allowance are not allowed. But what is allowed is travel, tour, and conveyance is allowed. Transport for a blind persons, 3,200 per month is allowed. Then again, 1017, member of parliament MPs allowance for the MP MLA is not allowed. 1032 minor income clubbing of minor में income का आता है ना 1,500 per child, that is not allowed. Then again 10A units of SCZ is not allowed. uh, Under section 16 deductions, professional tax and education and sorry entertainment tax is not allowed. Then again 24, the interest on self-occupied property is not allowed. Interest on let out property is allowed, but it is not set off against any other head. Then additional depreciation under section 32 1 2A is not allowed. Again 33AB, 33ABA, 35 out-house expenses is not allowed. In-house expenses allowed. Then again 35 AD is not allowed.
Yeah, good. So, what is not allowed here is LTA, HRA, any special allowances. What allowances are allowed are tour, travel, conveyance allowance, transport allowance for handicap up to 3,200. Allowances for MP, MLA, exemption for minors for 1,500, 10 AA. Your standard deduction is allowed up to 75,000. Right? Standard deduction which is allowed is up to 75,000 under the new scheme. Right? Under old scheme, what is the standard deduction which is allowed is
50,000.
50,000. Correct. Right? Under the new scheme, this is not allowed. Now, in your module, you will also see that these slabs are different, right? So if you look at, let me show you the module as well. I'll tell you the reason also that why is it different.
Yes, ma'am, for those applicable for assessment year 2025 and 26.
Correct. So in order to avoid that confusion, let me just make it very, very clear. So if you go to your module here, it says 3 lakh, 3 to 7, and it is increasing by 5% after every 3 lakh. Whereas in our this thing, we are saying after every 4 lakh, it is increasing by 5%. So why is it a difference? Because if you look at the act, it says for any previous year relevant to the assessment year beginning after 1st April 25. So from period April 25 to 26. So AY 25, 26, the slabs are this. But for AY 26, 27, the slabs are this. So just be careful about that, right? Secondly, now coming to the exemptions which are allowed or not. One second, sorry. Yeah. So here, as I said, you will not get the deduction for entertainment for the provision tax. You will not get the interest on the self-occupied property. You will get the interest on LOP or DLOP. But you will not get the interest on the self-occupied property. What about the losses from the house property?
It will not be adjusted, since it is if the interest is not allowed, there if there is any loss, it will also be not adjusted.
Yeah.
But
So we had
let
seen in the set off and carry forward chapter that the current year losses are not to be allowed with respect to the SOP. The interest is not allowed, so the loss is also not allowed. Any brought forward SOP loss also will not be allowed. The current year loss of the rental property, whether it will be allowed?
it will be adjusted only in the income of the house property, but it will not be
Correct.
adjusted in the other.
Correct. It will not be adjusted against any other income. And what about the brought forward losses?
It will be allowed now.
Brought forward will be allowed. So if you remember, we had seen that in the this particular chapter of set off and carry forward. The SOP current year loss is not allowed. Brought forward, not allowed. Rental property current year loss not allowed against any other income, but brought forward losses against the IFHP will be allowed. Fine. Then additional depreciation is not allowed. Normal depreciation is allowed. Deduction of expenses for tea, coffee, rubber, site restoration, scientific research in-house are only allowed. The expenses paid outside are not allowed. Right? Then deduction under 35 AD, Chapter 6A, brought forward losses in respect of any deductions or exemptions are not allowed. Unabsorbed depreciation relating to additional depreciation is not allowed. Fine. What deductions are allowed over here? 80 CCD 2, which is up to 14% of salary, employer contribution to PF, contribution to Agnipat scheme, 80 JJAA for the employees related, new employees related, right? So all of this will be allowed. Now, if you want to opt out of this scheme, a person and having PGBP, he can opt out only once, and once exercised, it shall apply to all other assessment year. He can also go back only once to 115 BAC, and then he can't come out. For person not having PGBP, he has an option to exercise every year on year. Clear? What about the rates of surcharge? Yes.
Under default scheme, 50 lakhs to 1 crore, 10%, 1 CR to 2 CR, 15%. It is total income including dividends and special rates under 1111A, 112 and 112A. And after 2 crores, it is 25%. Here total income is excluding dividends and 115, 1112, 1112A, 111A. For dividend and special rates, it is capped up to 15%.
Yes. So here the maximum rate of surcharge is 25%, but under the old scheme it goes to 37%. Right? So that is the big difference. What are the slabs under the old scheme?
Up to 2.5 mil, 2.5 to 5%, 5 to 10, 20%, about 10, 30%. And if resident, individual and senior citizen, 60 to 80 years, up to 3 lakhs, it is nil. And above that, it is 5, 10, 20, 30%, 5, 20, 30%. Then afterwards, for a super senior citizen above 80 years, up to 5 lakhs, it is nil.
Okay, good. So that is what is the slab under the old scheme, right? And what about the rebate? Rebate under 87 is allowed to resident individual for 115 BAC. What is the rebate? If the total income is less than equal to 12 lakh, 60,000 or the tax which is the lower. Right? And if the total income increases more than 20 lakh, 12 lakh, what did I tell you? Do you remember?
Then it would be slab wise, and there would be marginal relief also.
There will be?
Marginal relief.
No, not marginal relief. Yes. Can anybody recollect? If the total income is greater than 12 lakh, how did we calculate the rebate? I'm talking about rebate, not marginal relief. So, if you recollect, I told you the step 1 will be to find out the tax on the total income. Step 2 will be to find out what is the difference between the total income and 12 lakh. And your step 3 will be, the rebate will be basically the tax on total income minus what you get as the excess amount over 12 lakh as the income. So till 12 lakh, my rebate is 60,000. If my income exceeds 12 lakh, then the rebate is calculated in this way. Plus, you will not get any rebate on the income chargeable at the special rates. Clear? Now do you recollect? Yes or no?
Yes, ma'am.
Yes. And what is the rebate under the old scheme?
Tax amount at 12,500, whichever is lower.
Correct. So that is the rebate under the old scheme. Fine?
Yeah, does not exceed 5 lakhs rupees, the total
Yeah, it should
income.
not exceed, of course, 5 lakh rupees. That's it. Okay. Any questions with respect to this? So this is what we have already done in detail if you recollect in the basic concept class. Yes or no? So here in examination, you can get a question on determining the tax liability of the individual, wherein you will have to examine under both the schemes, old scheme as well as the new scheme. Alright, and then advise what is beneficial for the client. Whether he should go for the old scheme, whether he should go for the new scheme. Clear? Any question, any doubt? Yes? Is it clear, students? Should we solve one question from the module for the individual?
Yes, ma'am.
Yes? Okay, let me just take it. Let me just open up the module for you. Mr. Harish, age 66, is running a business as a proprietor, furnishes the particulars of the income for the year ended 31st March 25 as under. Net profit is 3,65,500. Personal traveling expenses 12,750. Purchase of furniture on 13 June 25,000, but charged in shop expenses. He owns a house with 2 floors constructed with the financial assistance of HDFC, out of which ground floor is used by him for self-use and the first was let out for 8,500 per month from April 24. Municipal tax paid for the whole house was 2,500 and interest paid on housing loan was 52. Both the floors of the house are identical. He deposited the insurance premium on the life of self, wife, son, and daughter, repaid the housing loan, and paid 55,000 by credit card for health insurance of himself and his family. Compute the total income and the amount of tax liability, assuming that he has exercised the option to shift out of default tax regime. Now, here you will add one line. You are not assuming this. This is going to be deleted. So my question to you is still only here, this point. So you have to tell me under which regime what will happen. Fine. So here's this net profit of 365,500. What about the personal traveling expenses?
Disallowed.
Add back, ma'am. It is not
Why?
allowed. It is not allowed because it is personal traveling expenses, section 37.
Correct. It is personal in nature, so 37 will disallow this. Purchase of furniture for shop on 13 June for 25,000 but charged in shop expenses.
It should capitalize. We should capitalize it, and we should take the depreciation on it at rate of 10%.
Yes. So here, if you look at what he has done is he has purchased the furniture but charged in the shop expenses. Now, this is an item of capital nature. So, obviously, this is not an expense. Here, you will get the depreciation. Isn't it? Here, we should get the depreciation. So, purchase of furniture, you will add back. And what is the rate of depreciation that you will allow on this?
10%.
10%.
10% for full year, right? Then he owns a house with 2 floors constructed with the financial assistance of HDFC, out of which ground floor is used by him for self-use and the first was let out for 8,500. Municipal tax is given and interest on housing loan is given. What will you do?
Under ma'am default old regime ma'am. It is under old regime, right, ma'am?
We are considering both the regimes here.
Under default regime 115 BAC, for let out portion, we will calculate the income 8,500 into 12, and then municipal tax we will divide 50-50 because both the floors are of the house are identical. They have given, so we will divide municipal tax and interest 52,000 by 2 because under new tax regime for let out property expense is allowed.
Yes.
And for SOP, self-occupied property, it will not be allowed.
Yes. So, under the default regime, if you go by, you will consider the only on the let out portion. You will not allow interest on housing loan on SOP. Municipal taxes any which ways are not allowed. All of this we'll divide it into 50-50% because he has 2 floors. So everything will be divided by 2. So for let out, under the default tax regime, no allowances. For the rented portion, the first floor which is there, 8,500 into 12 we will do, minus we will take into consideration the municipal taxes, which is 2,500 into 2. So divide by 2, 50%. So that will come, then less 30% standard deduction, and then interest on housing loan again divide by 2, 52,000 divide by 2 is 26,000. So that will give me the NAV of the renter. In case we are going for opting out of default tax regime, then you will also take interest on housing loan against the self-occupied property and you will adjust that against the LOP gain. Right? And whatever balance remains, you can adjust it against the PGBP income. Yes or no?
Yes.
Okay. Next is he deposited the insurance premium. What will happen to this?
Ma'am, 50,000 is allowed, ma'am. It's a senior citizen. The paid is 55,000.
Under the default tax regime, will you allow?
No, ma'am.
And the default we will not allow. Yes. Under default we will not allow. Under the old regime we will allow. But what is that we will allow?
Under old, under ATC, 12,500 insurance and 13,500, 28,000 will be allowed. And housing loan, if principal amount, it is allowed, ma'am, 50,000. And under 80D, for health insurance, only up to maximum up to 50,000 if he is a senior citizen. He is a senior citizen, so 50,000 will be allowed.
Yes, that's right. So, under the old regime, you will not allow 80D. That is very clearer. Now, coming to the new regime, you will not allow. Under the old regime, you will combine all of three. He will get for self, he'll get for wife, he'll get for son and daughter. Also, if they are dependent. Right? But the maximum that he will get is 50,000 because he is a senior citizen. This will also include 55,000 paid by credit card for the health insurance of himself and his family. Now, repayment of housing loan is allowed under 80C, that is 50,000. So, again, that will not be allowed under the default tax regime. Isn't it? Any question? Yes, any doubt, any question? Fine?
Clear, ma'am.
Okay. So now coming towards this is, completing the individual per se. Now coming towards the company. Let us start with the company. Now here, if you recollect, I had told you what are the different types of companies. Again, I think let us look at the basic concept class. Yes. What are the types of company?
Indian company, foreign company, domestic company,
What is an Indian company?
registered in India under the
Formed
Companies
and
Act.
registered under Companies Act. What is a foreign company?
Company which is not a domestic company is a foreign company, and domestic company is a Indian company plus any company which has made arrangement for the declaration of dividends within India is a domestic
Correct.
company.
Correct. So the foreign company, which is there, that is a company which is not a domestic company, right? And what is a domestic company? An Indian company or a foreign company which has made the arrangement for declaration of dividend within India. How do you identify whether the company has made the declaration of dividend in India or made the arrangements for declaration of dividend in India?
Maintaining registers of dividend in India,
There are other conditions also. Let me see who answers.
holding AGM,
Correct.
holding AGM in India, and maintaining books uh, dividends registered in India and paying within India.
Yes, that is right. So that is the way you will say that a foreign company can become a domestic company. Now, why is this distinction between a domestic company and foreign company is important?
Rates, at what rate income tax?
Correct. So what is the rate for the foreign company?
35%.
35%. Correct. And what about the domestic company?
Uh, Under default general tax rate 30%, and for
50.
Yes. So default is 30%. Then there are other tax rates also. What are those?
small company 25%, and for optional regime under 115 BAC, no, 115 BAA 22%, 115 BAB 15%.
Correct. So you have three tax rates for the company, right? General, what is a small company?
Turnover is less than 400 crore
Correct.
in preceding previous year.
Correct. And not the preceding in the previous year 23 24. Yes or no? So that is the basis that you will take for the purposes of determining the tax rate. So if it's a small company, then in that particular case, the tax rate which is there is 25%. Then you have the two concessional tax regimes which are given under 115 BAA and 115 BAB. Under 115 BAA, what is the tax rate? 22%. What is the surcharge on that?
10% flat.
10% flat. Under both, right? So that is the 22% plus 10% plus cess of 4%. Isn't it? And beyond that, you also have the incomes taxable at the special rate. So any income taxable at the special rate will continue to be taxed at the same rate of tax. Right? Because it will not, the 115 BAA or BAB starts with the notwithstanding any other provision but subject to the income already taxed under the special rate. Clear? Then what are the surcharges on the income taxable at the special rate?
10%.
Correct. The surcharge will still remain the 10%. Fine. Then what are the exemptions which you have to forego under 115 BAA and 115 BAB?
Section 80 deduction except 80M and 80 LCA.
Yes. What else?
80JJ.
80JJ is allowed. What you have to forego?
Section 35.
Yes. What else?
33
35
AB.
also not all. 35 may what
Total
is allowed?
in-house
In-house,
expenditure allowed.
in-house.
35.1, 35.1 and 35.4. Revenue and
So
capital expenditure in-house research.
correct. In-house are allowed. Yes, that's right. Then what else is not allowed?
33 AB, 33 ABA, 35 AD, Chapter 6 deductions.
Correct. So those are the deductions which are not allowed, right? So if you look at it, 33 AB, ABA, additional depreciation, 10 AA, then expenditure for scientific, chapter 6A other than 80JJA, 80LA and 80L. So this is what is not allowed under both the regimes, 115BAA and 115BAB. What are the conditions for 115BAA?
मैम BAA कंडीशन से BAB के लिए होगा मैन्युफैक्चरिंग शुड बी
Yes.
for BAB it has to be the manufacturing unit, right ma'am?
For BAA, which is there are no conditions per
No
se.
conditions. Yeah.
Correct? For BAB, there are of course the conditions. What are the conditions for BAB then?
Manufacturing and setup after 1st October 2022.
Yes. What else? Yes, students, faster. We have done this already. Okay. So here, if you remember, we have done that. What are the conditions with respect to the exercise of the 115 BAB? The first and the foremost is that this particular company which is there has to be engaged in the manufacturing or the production of the article or generation of electricity and should commence the manufacturing before 1/4/2024. It should have been set up or registered on or after 1/10/2019. Business is not formed by splitting up or reconstruction of the already existing business. It does not use any old plant and machinery. But what are the exceptions for that?
Imported, if it is imported, then it is
Imported transmission.
Imported is allowed. Yes. And secondly,
value of second-hand plant and machinery if it is less
20%.
20% of the
To
total.
20% of that.
correct. So value of total second-hand plant and machinery is less than total value of the plant and machinery, right? So these are some of the conditions which are there, and it should not be engaged in any business other than the business of manufacturing or production. What are the business of manufacturing or production includes? These are the businesses which it includes, right? So any incidental profit which is there, what will happen to that? How will its taxability work?
If it is not related to the manufacturing, then it will be taxed at 22%, and if it is related, then it 15%.
Correct. So any incidental income which is getting generated, right? If it is related to the manufacturing operation, then in that particular case, there's no problem. But if you look at it, I think I have written one point over here. Yeah, taxability of any other income not incidental to manufacturing. So that will be taxed at 22%, plus there will not be any allowance of the expenditure or any other allowance. Clear? Then STCG on the non-depreciable asset is taxed at again 22% plus surcharge of 10%. However, there is no restriction of the claim of the expenditure. There is no restriction in respect of the STCG. Clear?
Yes, ma'am. For both the MAT is not applicable.
Yes, MAT is not applicable in both the cases. Fine. And if there are any amounts which are greater than reasonable profit due to the close connection, so it is quite possible that the companies may try to transfer the profit from the companies taxed at 30% to companies opting for 115 BAA. So in that case, the transaction can be subjected to the arm's length price, and if it is a specified domestic transaction where the transaction is greater than 20 lakh, then it's subject to the ALP. And then in that particular case, it will be taxed at 30% plus surcharge of 10% and cess of 4%. Clear? When do you exercise the option of selecting under 115 BAA or BAB?
Before for BAB, before filing of the return, first return. Once it is opted, we cannot return back. BA we can opt any time, but it has to be opted before filing of the return.
Correct. And once you exercise, it cannot be withdrawn. Secondly, if you fail to satisfy any condition for 115 BAA, you can go as per the normal tax regime. And if you fail to satisfy 115 BAB, you can still opt for 115 BAA. Fine. Any questions, any doubts so far? Yes. Shall we solve a question on this particular company?
Yes, ma'am.
Okay, let us solve some questions. Okay. XYZ is engaged in the manufacture of textiles since 1/4/2009. Its statement of P&L shows a profit of 700 lakhs after the debit or credit of the following item. Now you have to tell me one by one. Depreciation calculated on the basis of useful life of asset as per the provision of Companies Act.
Add back.
Add back, right? Next is employer contribution to PF of 2 lakhs that was remitted on 30th June 2025 for the month of the March.
Since it is paid before the filing of the return, it will be allowed now. Employer contribution.
Employer contribution.
It will be allowed. Employee contribution will not be allowed.
Correct. So employer contribution, under which provision you are allowing the same?
No, no, as per that applicable act in the next month, within 15th of that, we have to pay. The employee contribution is not paid. Hence, it's not allowed.
But which is the provision for that? Which
Section
section?
36.
Correct.
36.
For the which one? Employer or employee contribution?
Employer 36(1).
Correct. Employer contribution is 36(1)(5)(a). Sorry, employee contribution is 36(1)(5)(a). For employer contribution, which is the section?
36(1)(b).
And
Due date should be as per the due date of the specific act of the provision in which he has been contributing.
so let us go back to our 36.
Yeah, as per 139(1 is before honor before due date, and it's allowed as 43B.
43B.
Correct. Very good. So employer contribution to PF is allowed under 3614, but it is subject to 43B that it should be deposited before the due date under 139(1). Yes. So here if you look at it, here the employer contribution is deposited before 30th June 2025, which is as per the due date of 139(1), which is well before the due date of 139(1). And therefore, as per 43B, the employer's contribution to PF is allowable as the deduction. So therefore, no adjustment required. Employee's contribution to PF, if you look at it, it is given under 3615A. So this is how you will be presenting. First, you will consider this as the income of the employer under section 224(10). Under 224(10), this will be considered as the income of the employer. You will not add back to the, you will not say that item disallowed. You will say this is first income of the employer less deduction under 3615A, not allowed because it is not deposited before the due date of the fund, which is 15 days. So here you will write the explanation to section 43B specifically provides that the employee's contribution to the provident fund is not to be allowed under 43B even if it is paid before the due date of filing the return of income. Clear? Yes? So you understood how we have to make the presentation?
Yes, ma'am.
Right? The company appended a note to its income statement that industrial power tariff concession of 2.5 lakh were received from the state government and credited the same to the P&L.
No adjustment.
Why?
No adjustment. Revenue link.
Which section?
Only
145 B says that subsidy, whenever it is received, then we will be recording in the books when it is received. Method of accounting 145B. So it has received in this year, so we'll be record, and it is not linked to the asset, so we will not capitalize it, and we will take to P&L only.
Let us look at which ICDS is it?
ICDS 7.
Correct. ICDS 7. So any subsidy or the financial assistance, right? This is taxable in the previous year of receipt. Yes or no? This is taxable in the previous year of receipt. Now, this particular income, which is there, this is an income, right? This is not related to any asset per se. This is not related to any asset per se, isn't it? So this will be allowed as this will be considered as my income. Right? If you also look at this particular section 28(4), any benefit or perquisite arising from business or profession, whether in cash or kind, whether convertible in money or not. There also subsidy gets covered. If it's a revenue subsidy, this is income under 224. Right? So in that particular case, here what they have said is that the company has received a 2.5 lakh concession from the state government. It has received it from the state government, and therefore this is what? This is a revenue subsidy. Isn't it? This is my revenue subsidy. Now, if it is a revenue subsidy in that particular case, what does the ICDS says? That it shall be recognized in the year in which it is received, as you correctly pointed out, even under section 145B. Subsidy or grant received recognized in the previous year in which it is received. Clear? So this, it has already been credited to the P&L. No further adjustment is required. Fine. Next is the company has provided, yes.
सब्सिडी है वो 25 के नीचे आएगा क्या मैम? 28.4 के नीचे एडिशन.
करेक्ट. So see, 28.4 में क्या आता है? 28.4 में आपका generally any kind of perquisite which is arising in the business will come. Right? Now, if you recollect here, हमने जहाँ पे 28.4 के लिए बात किया था, so I told you any revenue subsidy is already an income under 224. If a subsidy is a capital subsidy, right, and it is not relating to the capital asset, this will be covered under 28.4. रेवेन्यू सब्सिडी तो ऑलरेडी इनकम ही है. 28.4 में क्या आ रहा है? जो हमारा कैपिटल सब्सिडी है, which is not relating to the capital asset. If it is relating to capital asset, you have to go as per ICDS 7. If it is not relating to capital asset, it will go under 28. Clear?
Okay, ma'am. Clear.
Yeah. Okay. The company had provided an amount of 25 lakh being sum estimated as payable toward the workers based on the agreement to be entered with the worker union towards periodical wage revision once in 3 years. The provision is based on fair estimation of wages and reasonable certainty of revision once in 3 years.
Yes, ma'am, it is allowed, ma'am. The thing is that it's a fair value estimation based on the provision as per the ICDS 10 is allowed.
Correct. So, what does my ICDS 10 says? My ICDS 10 recognizes the provision. Right? ICDS 10 says provision shall be recognized when there is a present obligation arising out of past event. Now here there is an obligation of 25 lakh arising from the estimation that they have done that there is always a revision once in 3 years. So this is based on some past event. So there is a present obligation arising out of past event. First condition fulfilled. Second, it says there is reasonable certainty that there will be outflow of resources to settle the obligation. Yes, there is a certainty because once in 3 years I have to make the revision. So there is a certainty that this year also I have to. There is a reasonable certainty. Third is a reliable estimate can be made for the amount of obligation. Here I have made an estimate based on the past track record, based on the agreement to be entered with the workers. So therefore, we will recognize this as a provision. Since it has already been claimed as a deduction, no further adjustment is required. Fine. The company had made a provision of 10% of its debtors towards the bad and doubtful debt. Total sundry debtors were 200 lakhs.
Ma'am, it's not allowed, ma'am. Only the banking company and financial institution only it is allowed as per 36. But it's, this is a manufacturing of textile company.
Correct. So provision for doubtful debts, 10% of 200 lakhs you will disallow because provision for doubtful debts is not an allowable expenditure, right? Actual bad debts are allowed under 3617. Under 3617A, you allow it only in the case of bank, public financial institutions, state financial corporation, industrial investment corporation, and NBFCs. Fine. Next is a debtor owed the amount, company an amount of 40 lakh was declared insolvent and hence was written off by debit to the statement of P&L.
Yes, ma'am, because since income is recognized at the time of sale is booking, now it's written off, it's allowed, ma'am.
Correct. It is allowed. The bad debts written off actually are allowed under section 3617. Fine. Sundry creditors include an amount of 50 lakh payable to A and Co towards the supply of raw material which remain unpaid due to quality issues. An agreement has been made on 31st March to settle the amount at a discount of 75% of the outstanding. Amount waived is credited to the statement of P&L.
Ma'am, this is due to the quality issue. It's not a breach of contract. Hence, it is allowed.
But this is the income, isn't it? This is not an expense.
Yeah, it's income. Income actually. Income
Income.
means, yeah, already they are credited in the P&L, then I think no action is needed on this.
Correct. So under 41(1), if there is any deduction claimed in respect of expenses, trading liability, right? And there is now a benefit obtained through the remission or cessation of the liability. Do you recollect this point? 41(1). So what do we do in that particular case? Where a deduction is claimed and in subsequent year there is benefit due to the remission or cessation, benefit shall be deemed to be the PGBP in the year in which benefit is obtained. Now in this case, the 25% of 50 lakh is a benefit which is obtained. This is already credited to the P&L and therefore no further effect is required. Fine. The opening and closing stock of the year were 200 and 255 lakh. They were overvalued by 10%.
We have to adjust the gross profit now. We
Yeah.
have to reduce the value of the opening stock by 10% and closing stock also by 10%.
Over event is opening stock if it is over related 2 lakhs means it's 220 it's put to the extent that 20 lakhs is reduce the profit, and 255 it's overvalued means to the extent of 25.5 lakhs it's over, then its a profit is increased to the extent we have to reduce that.
Yeah. So, which means if I simply write it like 55 lakh is overvalued, 255 minus 200, right? Because my closing stock is taking the profit on upper hand and 200 reduces my profit. So, 200 is overvalued means I have to add back.
Yes.
Opening stock reduces my profit, right? You do it on the cost side. 255 you have added on the income side. So means that should be reduced down. So net effect is 55 is by 55 lakh my profit is high. Correct? 55 lakh into 10% into 10 divided by 110 is the profit is high. So what will I do? I will reduce. Right? I will less overvaluation of stock, which is 55 lakh into 10 divided by 110. Clear? Yes?
Yes,
Yes,
ma'am.
ma'am.
Provision of gratuity based on actuarial valuation was 500 lakh. Actual gratuity paid debited to the gratuity provision account was 300 lakhs.
Actual gratuity paid alone is allowed as a deduction. Here 300 lakhs is allowed, but however they provided for 500 lakhs, they debited the actual paid into the provisions. So to the extent of 200 rupees, we go to disallow.
Correct. The provision for gratuity is not allowed under which section?
40A.
48.
40A7. Yes, 40A7 says that the expenditure on the gratuity is not allowed, right? Provision for gratuity is disallowed. Actual gratuity paid, if it is deposited before the due date under 139(1) is allowed. Right? So here 200 lakh we will add back. Next is commission of 1 lakh paid to a recovery agent for realization of a debt. Tax has been deducted and remitted as per chapter 17B.
Yes, it's allowed, ma'am.
It's an allowed, right? So this is a expense which is allowed. TDS is deducted, so there is no problem, no adjustment required. Company has purchased 500 tons of industrial paper as the packaging material at a price of 300 per ton from PQR, a firm in which majority of the directors are partner. PQR's normal selling price in the market for the same material is 28,000 per ton.
Yeah, it's not as per the arm's length price. Then the difference between the 30,000 and 28,000 to be reversed out there 500 a ton.
Yeah. So here what we have to do is, first of all, we have to say that whether these are related parties or not. First, you have to examine that. Yes or no? So if you recollect under disallowances, under 40, I had told you that in case of a company, right? In case of a company, if the director or member or partner having the substantial interest or any other company in which the company one has the substantial interest. So, in that particular case, the two entities are considered as related to each other. Right? So, here if you look at the director of a firm in which majority of the directors are partners. Right? So, the director is partner in the other firm. So, the firm is related to the company. Right? The firm is related to the company. Now, if the firm is related to the company, it has to be at the transaction has to be at the fair market value. The expenses have to be at the fair market value. Do not write the term as arm's length price. Write the word fair market value. For 48.2, the expense cannot be more than the fair market value, not the ALP. Here you will not use the word ALP. So don't use the words loosely in the examination. Whatever word is there, you have to write that term itself. So
Okay,
here
ma'am, got
it is. Got it? So 30,000 minus 28,000, 2,000 per ton into 500 tons will be added back under 40. There was an addition to the plant and machinery amounting to 50 lakh on 10 June 2024, which was used for more than 180 days during the year. Additional depreciation has not been adjusted in the books.
We have to, since it is a manufacturing company, so we can take the additional depreciation at the rate of 20% under section
Correct.
32(1)(2)(a).
Correct.
Yes, ma'am. The reason is that it's taken on 10/6, which means more than 180 days.
Correct. So 20% entirely will be allowed on 50 lakh. Then you have normal depreciation calculated as per the income tax rule is 80 lakh. This you will reduce. Next is the company had created a subcontractor an amount of 10 lakh on 31st March towards repairing a machinery component. Tax so deducted was remitted on 31st December 2024.
30% disallowed, ma'am, since it is paid after due date of filing of the return.
Correct. So here, this particular amount, which is payment to a subcontractor, now this is not debited to the P&L. This is the company had credited to the contractor the amount towards repairing a machinery component. The tax so deducted was limited on 31st December. This is given in the additional information. This is not given under the amount debit or credit to the P&L. So this amount has not been debited or credited to the P&L. So payment to a subcontractor where tax deducted last year was remitted after the due date of filing of return, but this amount is pertaining to 31st March 2024, for which the tax had already been deducted in 31st March 24 but is remitted on 31st December 2024. And which is the financial year for which we are examining the tax impact? AY 25-26. This is pertaining to which particular year?
24-25.
Correct. So what you will have to do here?
30% allowed, ma'am.
30%.
Correct. Correct. So here, what you have to do is you have to allow the 30%. You have to reduce the 30% over here. And what you need to do is you have to basically reduce the 30% because this has not been debited to P&L at this point in time. It was disallowed last year, so 30% you will allow it in this year because in this year the TDS has been paid. Fine. Next is the company has collected 7 lakh as GST from its customer and paid the same on due dates. However, on an appeal made, the High Court directed the department to refund 3 lakhs to the company. The company in turn refunded 2 lakhs to customers from whom the amount was collected, and the balance of 1 lakh is still lying under the head current liabilities.
Ma'am, whatever the collected from the refund from the GST, it has to be refunded to the customer immediately.
Yeah,
If not, it has to be treated as a income for the company.
correct. So here 7 lakh was collected from the customer. However, the High Court directed to refund 3 lakh to the company, out of which 2 lakh it refunded to the customer and 1 lakh it is still lying. So this 1 lakh which is still lying will be deemed to be the income of the company. Because it has not refunded and it had claimed the deduction of GST when it paid it, now it is a benefit arising to the company, so 1 lakh will be considered as the income. Fine? Yes or no?
Yes, ma'am.
Okay. So this is here you have to compute the tax liability. What will be the tax rate? You are required to ignore the provisions of 115BAA.
At 30%, ma'am, normal.
30% normal, right?
Because
Okay.
turnover is greater than 400 crores.
Correct. The turnover is more than 405 crore. So therefore, here the 30% tax rate will apply. Whether there will be any surcharge, that you will obviously know once you know what is the total income coming. But if it is more than 1 crore, 7%. If it is more than 10 crore, it will be 12%.
Yes, ma'am. The basic thing is that it's a profit and loss account 7 crore is there. But definitely the tax rate 30% means it will come more than 1 crore.
Correct.
But 7% will be there.
Yes, absolutely. Fine. Any questions, any doubt?
And also we need to put the education chess as well.
Yes,
Health and
of course, we need to put the execution cess as well. Okay.
Clear, ma'am.
Any questions? Yes. Okay. Let us take one more question. Let me just open up that question. Give me a minute just. Yep. The following are the particulars relating to the two Indian company, Alpha and Beta. This is the date of setup and registration, main object, manufacture of steel and leather. This is the place. This is the turnover given of the last 3 years. This is the value of plant and machinery installed and put to use on 1st November 24. Gross total income of the previous year 24-25 is given. Number of the new employees employed on the date of setting up or registration of the company. Number of employees employed as on 1/4/2022. Monthly emoluments to 750 employees employed in the respective companies as mentioned above by ECS through bank account for different employees, different pay scales are given. From the above details, compute the tax liability of Alpha and Beta. Alpha has not opted for any concessional tax regimes earlier and want to avail the beneficial rates under the special provisions of income tax in the previous year 24-25. Beta has already opted for 115BAB and wants to continue the same in 24-25. Assume the GTI reflects the computation under the special provision. Would it be beneficial for Alpha to opt for beneficial rates in 24-25 instead of paying under the regular provisions? So let us start with it. First, what do you have to do?
First, date of setting up and registration, since it is 1/4/2019 and 1/3/2024, then it will be eligible, ma'am, for Beta Limited will be eligible for 115BAP. And since both are manufacturing, So it will also be eligible for a optional regime.
Sorry, students, I think there was some network connectivity issue. Okay. Yeah. I lost you completely in between. Could you please repeat it?
For Beta Limited, since it has opted 115 BAB, it is we have to check whether the date of setting up and registration is on or before 31 3 2024. So it is 1 4 2024. So it is on or before. It is on 1 3 2024. It is eligible for 115 BAB, and since both are manufacturing of an article, then it is also allowed under optional scheme of credit.
Correct. So here, first we look at first alpha. This is incorporated after 1/4/2019. Now, do you think it can go for the concessional tax regime first of all?
No, ma'am. It incorporated before 1/10/2019. So not BAB allowed.
So, first of all, if you look at this particular alpha's nature of income, right? So, it is a manufacturing company, no doubt about it. But as we looked into this particular thing, it said it should be set up and registered after 1/10/2019 for the purposes of 115 BAB. So it can't opt for 115 BAB. So though it is a manufacturing company, it can't opt for 115 BAB. It can opt for 115 BAA. Right? It can go for 115 BAA. Now, as far as this beta is concerned, this is already opted for the concessional tax regime and it is given under 115 BAB. It has gone. Right? It has already gone into that. So this is set up 1st March 2024. Right? Now, this has already gone into that particular section. So there's no question over here. Now, with respect to the alpha and betas, now tax computation, you have been given the gross total income of 5 crore and 5 crore. Right? Now, for the alpha, whether you will claim the deduction under 80 GGAA as well as for beta, whether you will claim that?
Yes, ma'am.
We will
Both the yeah,
Yes. New and
Yes,
old.
ma'am.
ICAI and
both the
BABS
regime,
are allowed.
correct. Under both the regime, we will be able to claim the 80 GGAA. Now, first
Yes,
we'll calculate for the alpha. What they have said is that number of employees employed on the date of setting up or registration of the company are 50. Number of employees employed as on 1/4/2022. This is the information given to years 750.
yes, ma'am. If
Right?
this is a manufacturing of steel company, it's more than 240 days if the employee is employed. Then that
240,
80,
yes.
yeah, 240 days. In case of leather company, the beta is a leather company. For
Correct.
there is a concession also is available. 150 days is there.
Correct. So for alpha, you will have 240 days. For beta, which is into the leather, it is 120 days.
150.
150, sorry. So in case of alpha, you will get 30% of the additional employee cost of the new employee for the previous year 25-26. Now, out of my 750 employees which are there are 750 employees as on 1/4/2022. Out of 750 employees, I think this date is wrong. This should not be 1/4/2022, I suppose.
Yeah, which means they employed prior to this period.
Yes. So this
But
is wrong date. This should be 1/4/2024.
yeah, I think it has to be employed in the current year. Then only it is
Correct.
allowed.
Correct. So out of 750 employees, they are giving that 250 employees which are there have the emoluments 20,000 per employee. Now, whether 20,000 per employee will be covered?
Yes, ma'am. It's covered.
So 20,000 into 250 employees into 12 months.
12
This
months.
is what, I don't know, it's per month or how is it? I think it's per month.
Yeah, per employee per month only, ma'am.
Yeah.
It's per
So I
month.
think we will have to, I don't know whether it's written somewhere that this is per month, monthly emoluments. It's written monthly. So we will do into 12. Correct?
Ma'am, yes, ma'am. It cannot be whole
Right.
year. Yeah,
Absolutely.
20,000. Yeah, people will not come for 2,000 per month.
Yes.
But question can be asked like that.
Yeah, absolutely. So it's given and it's monthly. Then 25,000 per employee.
Yeah, it's allowed. Up to 25,000 it is allowed, ma'am.
Up to 25 it is allowed. So 25 into 12 into 250. What about 28,000?
Not allowed because exceeding 25,000.
Correct. So beyond that, it exceeds 25,000. So does not qualify as the additional employees. Clear? So this has to be the current employees 750 which are there. So this is something which is allowed. After that, if you look at it, now coming to the beta. Beta has again 750 employees as on the date of registration. So 21,000 per employee, 250 employees. Again, this will be allowed. Yes. So
Yes, ma'am.
21,000 into 12 into 250. Then 25,000 will also be allowed. 25,000 into 12 into 250. This will not be allowed. And for this additional employee cost, do not forget that the deduction under 80JJAA is 30%.
30% extra allowed in addition to the normal emolument.
So 30% is allowed as 80JJAA. Normal we have already considered under GTI. Correct? So this gives me my deduction and basis that you will compute a total income. Now what will be the tax rate for the alpha?
25%, ma'am.
25%.
So turnover is less than 100 crore.
Turnover
22%.
of the, yes, turnover
Ma'am,
is more than 400
more than
crores.
400 crores. So it is 30%.
It is
401 crore.
30%, right? Now
Yeah.
you are required to examine that whether it is beneficial for the alpha to go for the concessional tax regime. So how will you compare? You have the gross total income given over here, which is the 5 crore. What will you do additionally over here?
New
Sorry,
plant and machinery additional depreciation will be allowed in the
correct.
old, and it will
Yes,
not be allowed in the new regime.
yes. So in the normal tax regime, you will allow on 8 crore additional depreciation. How many days it is put to use on 1st November? So less than 180 days, right? So
10%.
you will allow 10%, correct? So GTI will come, your 5 crore minus 10% of 8 crore, 80 lakh, which comes to 4 crore, 20 lakh. Minus you will allow the 80 double G double A. Correct? So this will give you your total income. Now turnover of previous year 23-24 is 401 crores. Had it been less than 400 crores, then in that particular case, we would have allowed 25%. Otherwise, now it becomes 30%. So you will compare 30% with the 115 BAA tax liability, which is 22 plus 10 plus 4%. And you will advise alpha whether it should go for concessional tax regime or not. Clear?
Ma'am, we have to see the turnover of 22-23 or 23-24.
23-24. We are looking at AY 25-26, right? So,
Yeah,
we are
25-26 means is the previous year is 24-25. Prior to that, it's 23-24.
23-24. We have to see 1 year, 2 years prior.
From the
So
assessment year.
251 crores. So we have to take 25% tax
No,
rate,
no, no,
ma'am.
no, no. We are looking at AY 25-26, right? Previous year 24-25. Sorry, yes. You have to look into this particular. So here we are looking at AY 25-26, which is for, you have to look previous year 23-24 turnover.
Yes, ma'am. That is 401 crores.
Yes, that's 401 crores. Okay?
Yeah, since it is less than 400 crores, then we can go for 25
It's
percentage.
more than 400. It's 401 crore.
think
Fine?
ma'am, in
Yeah.
textbook I think it is they have taken 20 to 23 turnover,
In the
ma'am.
solution, right?
In the solution they have taken 20 to 23.
No, but if you see in the solution, they have said that the turnover of previous year 23-24 is less than 400 crore. They have written previous year 23-24. They have mistakenly, either they have mistaken the amount over here or in the solution. But they have taken the previous year 23-24 itself. So if you go to the solution here and look at it, see, it says previous year, okay, 22-23 it is given. Okay. So I think
This one, preceding previous year's turnover, we have to check.
that is right, but one second. If you look at this chapter
We will
one
go,
also,
yeah, we will go back to the basics of charges. You will see prior to
yeah,
prior year of parties.
I think if you go to no, this one itself, assessment. For the companies, where the tax rates are given in the module, and so I think it's given in the basis of charge, isn't it? Basic concept class.
Yes, ma'am. Basics of charges.
Yes.
It's on page 9.7.
Yes, ma'am. It is does a turnover of the gross total received is financial year
But
2022 and 23 is less
in the
than
22.
400 crores.
Okay, it's 22,
in the
23, you
previous
are
year
saying.
22-23, it should be
Okay, so then,
for less than 400.
yeah, it is previously 22-23. One second, let me just cross confirm
Page
here. Yes.
9.7. Page 9.7.
Okay, yeah, it's previous year 22-23. Yes. So here we will take it into consideration 22-23. Yes. So, yes, then it's correct. So then in that particular case, it is less. So you will compare with that particular amount. 25% versus the 22 plus 10% plus 5%, 4% surcharge.
Otherwise, it will be 30 percentage.
Yes. So 25% flat 3,75,000. There is no surcharge since the income is less than 1 crore. So you will compare this with the 22 plus 10 plus 4%. And they are saying here that this is 3,90,000 vis-a-vis the tax liability of 23,90,000 under 115 BW. So this is more beneficial. Fine. Yes.
Right, ma'am.
Yes, ma'am.
Okay. Okay. So with this, let's take a break of 10-15 minutes and then we'll start back again with the minimum alternate tax. Okay. Yes. the minimum alternate taxes. Okay, so what is this minimum alternate tax? What is the objective behind this, students? Let us try and understand. See, the companies which are there, what they try to do is they basically try to, reduce down their profit as much as possible, thereby resulting in zero tax liability or minimal tax liability sometimes. But these companies were also distributing huge amount of dividends. And that is the reason why this minimum alternate tax concept came into picture, which said that even if the companies are like disclosing or distributing so much of dividend and yet they are not paying any taxes. So minimum alternate tax will ensure that the companies have to end up paying at least this minimum tax of 15%. So what is the minimum alternate tax rate? Minimum alternate tax rate is 15%. So the companies have to mandatorily pay this 15% tax rate. What is it? 15. So to whom this is applicable? To whom minimum alternate tax is applicable? This is applicable to both the companies, domestic as well as foreign. This is applicable to both the domestic as well as the foreign company. So minimum alternate tax applicability domestic and foreign company both. I'm sorry, I think there was some network issue. Yes. So domestic as well as the foreign company. Now, what are the exclusion from this? So for there are certain companies where the minimum alternate tax is not applicable. What are these kind of companies? So first is for the domestic company, what are the exclusions? Can you tell me? What is the exclusion for the domestic company? To which kind of companies minimum alternate tax is not applicable?
Ma'am, the company who has exercised the option 115 BAA and BAB.
Correct. Secondly, so the companies opting for 115 BAA or 115 BAB, to them minimum alternate tax is not applicable. Clear? Next is for the companies which are life insurance corporation, LIC.
115B.
Yes. Which are into the, not LIC, basically life insurance companies and not life insurance corporation per se. So the companies which are basically not having the which are into, sorry, the insurance business. Right? The companies which are into insurance business have this 115B, has this 115JB section not getting applicable. So these are the exclusion for the domestic company. What are the exclusion for the foreign company? Any idea?
If they're done under the 44AB,
so that is the section that we are going to see in the coming lectures in the international tax class. Okay, also one more thing, students, I just forgot to tell you that, yes, the point that we were discussing with respect to this previous year 23-24, this particular point, right, for the small company. If you see in your module, this is for 23-24. See, in your module, there are two sections. If you look at this May, September 26 and January 27 examination. So for that, it is previous year 23-24. Are you getting this? So I had
yes,
written
ma'am.
correctly only, even I got confused. Like I was wondering how that could be the case.
Yes, ma'am. We used the old module. That's the
Yeah,
reason.
we use the old module because there are two modules available on the website. So students, please do not get confused. Here, if you go to this is May 26, this is May 25, September 25, which is already gone, and January 26 examination. For January 26 exam, if it is there, then this is the 22-23. But if it is May 26 that you are studying for, then in that particular case, it is going to be previous year 23-24. Right? It is
Yes,
previous year
ma'am.
23-24. Please do not get confused. Even I got
For-
confused when you were telling me. So,
Yes, ma'am. For AY 26-27, it's clear that 23-24 is applicable.
correct. So, please be very, very careful as to what you are referring to. Okay? Now, coming back to the assessment of various entity. For the foreign company, what are the exclusions? For the foreign company, the exclusion is if a foreign company includes, its total income includes the presumptive profits under 44B, BB, BBA and triple B. So, next. Foreign company, Mega, I will answer your question. Give me some time. Yeah. For the foreign company, which is a resident of its country, with which India does not have a DTAA, and it is not having any permanent establishment in India. Okay. So, a foreign company which is resident of a country with which India has DTAA and it does not have PE in India. Okay, it does not have PE in India. Secondly, a foreign company is resident of country with which India does not have DTAA, and it is not required to register in India. It is not required to register under the Companies Act, meaning it doesn't have any business here. So these are some of the exclusions. Otherwise, it is applicable to both the domestic as well as foreign company. When it is applicable when your tax on total income is less than 15% of book profits. If that be the case, your book profits are deemed to be the total income. Clear? Your book profits will be deemed to be the total income. Are we clear up till this?
Yes, ma'am.
Yes.
Okay. Any questions, any doubt? Fine. Now, once it is book profits are deemed to be the total income, students, that means all the provisions that are applicable to the total income will now be applicable even to the book profits. So, which means that you will required to pay the advance tax. If you do not pay the advance tax on time, you will have to pay the interest, right, under 234B, under 234C, because your book profits are now deemed to be the total income. So all the provisions which are applicable to the total income will equivalently be applicable to the book profits also. Are we getting this particular point? So even in that case also the interest under 234B and 234C will be applicable. So get this very, very clear. So just because now your book profits are deemed to be the total income doesn't mean that other total income provisions will not be applicable. It will still be applicable. Fine. Now, how do you calculate this book profit? So explanation to 115 JB. 115 JB is what is, levying the math. So explanation to 115 JB defines or provides how to calculate the book profit. So it says that the book profit will be basically the starting point for that will be your net profit. So every company is required to prepare its P&L as per the Schedule 3 of Companies Act, right? Except for the insurance, electricity, banking company, under which the Schedule 3 is not applicable, they prepare as per their governing law. However, the starting point will be the net profit which is arrived at as given under the Schedule 3. And this will be increased or reduced by the adjustments that are only provided in explanation 1 to 115G. If there is any other disallowance under the Income Tax Act, that will not affect it. So, whatever the adjustments are provided only in the explanation 1 to 115JB, you will only provide that. No other disallowances will be made. Fine. So just write down book profits deemed to be the total income. Therefore, advance tax, interest under BC applicable. Clear? MAT will be further increased by the surcharge and cess. Surcharge and cess remains the normal as you have for the normal taxes. Now, how to calculate book profit? Net profit as per the profit and loss account which is prepared in accordance with the schedule. Clear? Net profit as per the profit and loss account as per schedule 3. Add or less the adjustments as per explanation 1 to 115 GB. Okay, now what is the first adjustment relating to? So the first adjustment which relates to is the income tax. First adjustment is the income tax. So you need to add back the provision for the income tax. So any provision that has been created in the profit and loss account for the income tax payable, that has to be added back. Now this will include interest, income tax, surcharge, cess, all. So this includes income tax, surcharge, cess, or even interest on income tax. What about the penalties? Do we add back the penalties?
No, ma'am.
No, ma'am.
Don't.
Not allowed.
Yes. So under the normal provision under 37, this is disallowed. Right? However, under MAT, allowed. So in the MAT, you will not add back. Fine. Add deferred tax less any deferred tax credit. So any deferred tax which is taken as deduction, you will add. Any deferred tax credit, you will use. So this is the first adjustment. Fine. Second adjustment is with respect to the amount transferred to the reserves. Amount transferred to the reserves. So add any amount transferred to the reserve less any amount withdrawn from the reserve. Clear? Third is provision other than provision for a certain liability.
What is meaning by asset and liability, ma'am?
Let me explain that. So, again, going back to the PGBP section, we had discussed this. The ascertained liabilities which are there are basically the liabilities in presentile, which is what you can recognize as a provision. There is a present obligation, the determinable liability. There is a reasonable certainty with which there will be outflow of resources. Estimate can be reliably made. So basically, the liabilities which are ascertained, not unascertained, which are presumably going to be there, reasonably there is like 99% chance that this liability is arising. So that provision is for ascertained liability. So you
Okay.
recognize the provision for ascertained liability even under the normal provision. Same here, they are saying that you disallow the provision other than for ascertained liability. So what can be the provision that are allowed for the ascertained liability which are there? That's fine. But what are this? Ascertained liability provision? Provision for warranties. Right?
Yes, ma'am. We have seen in the question number one when we solved the workman salary compensation for 3 years,
Correct.
the proceeded 25 lakhs.
Correct. So what is therefore here disallowed? So add any provision for unascertained liabilities unless any amount withdrawn from provisions. Clear? So here you will also disallow the kind of provision for loss of subsidiary company. Right? So what does it include? Provision for loss of subsidiary company. Transfer to the revaluation reserves. Again, this you will add back. Then provision for diminution in the value of asset. Provision for income tax. Clear? So these are the unascertained liability.
Ma'am,
So you will
what is the provision for the diminution of the value of the asset?
decrease in the value of asset.
Okay. It's impairment like that.
Yes, impairment is actual writing off, but here I'm creating a provision that there may be decrease in the value of asset.
Okay. Based on the provisions, not as per the action.
Correct. So
And
provision for loss of
ma'am, provision for income tax is covered in first point also.
yes, I'm just giving you an example over here.
Okay.
So provision for loss of subsidiary company you need to add back. Similarly, transfer to the revaluation reserves.
Ma'am, why that the provision for loss in subsidiary company is provided in the holding company?
So many times the holding company will want to like it will feel that the subsidiary company is making the losses, so it may want to make a provision to reduce down the value of investment in the subsidiary company. So that is nothing but the provision for losses of the subsidiary company. Fine.
Okay.
Next is transfer to the revaluation reserve. So Any transfer to the revaluation reserve. So basically amount transferred to the revaluation reserve had to be added back. Less amount withdrawn. Okay. Next is provision for diminution in the value of asset. Again, this needs to be added back. Next is provision for, dividend paid or proposed. And depreciation. Now, under normal provisions, what do you do? Under normal provisions,
Depreciation is added back and income tax depreciation is deducted.
so depreciation as per books of accounts, you add, and depreciation as per section 32, you reduce, right? Here, you don't need to do like this. Here, what you need to do is you need to add depreciation as per the books of accounts, including the depreciation on the revaluation of the asset. Including the depreciation on the revalued asset.
Which means the extra depreciation on the revaluation to be removed.
Correct. And you will less. Here, depreciation, again, what you will less will not be as per the income tax. This will be as per the books of account. But this will be excluding the depreciation on the revalued asset. But this is how the presentation needs to be done. So in effect, what we are trying to do is, so the effect that comes is, we are adding back depreciation on only the revalued asset. Because we are not allowing under the MAT the revaluation of asset, we are also adding back the depreciation on the revalued asset. Fine. Then next is income exempt under section 10, 11, 12. So you will add any expenditure in relation to such income and you will less the income exempt. Fine. So any income which is exempt under 10, 11, 12 will be excluded. Next is the notional gain or loss on transfer of share of SPV in exchange of units of business trust. So, notional gain or loss arising on transfer of share of SPV to a business trust in exchange of units of business trust, or notional loss on change in the carrying value of units. Now, any loss you will add back and you will reduce any gain. For now, just understand that we are not allowing the notional gain or loss. This particular point, what is it? Wait for this chapter to get over. In the next chapter, immediately you will understand this as the first point. So just wait. You can write here business trust goods. Fine. So if I am disallowing the notional, I will actually allow the actual gain or loss on sale of units. So for now, I'm just telling you we are disallowing the notional gain or loss, but we are allowing the actual gain or loss on units transferred of the business trust. So basically, we are allowing you will add the gain and you will reduce the loss. But for now, just hold on to it. Okay. Next is share of member in the AOP. Or the BOI, where no tax is payable under section 86. So add loss less gain. Or you can also write add any expense and less any income. Let's write like that. This is not gain or loss. This is share basically. Again, just write here, refer AOP BO1. So just wait for these two adjustments. Just wait for some time. Everything will get cleared. Next is income of the foreign company. Which is in the nature of capital gain, interest, royalties, fees for technical services. Capital gain, royalties, interest, dividend, fees for technical services. Where the income is chargeable to tax under the special rates of taxes. So, for this foreign company, any capital gain arising on transaction in security, we can specifically write like this. Only capital gain on securities. But for interest, royalty, FTS, dividend, the income is chargeable to tax under 115A. 115A is the special rate of tax for these particular income. Then these income have to be excluded on which the MAT is not payable if the rate under that section is less than 15%. Are we clear? It is less than 15% even on account of DTAA, then also you have to reduce it. Clear? So you
Yeah,
will less
if
the
more than
income.
we will not consider that, right, ma'am?
Correct. On that, MAT will not be
Whether
applicable. Otherwise, the benefit of concession will go away under the MAT. Okay. Then the last one is the brought forward business loss and the unabsorbed depreciation. So in the case of a normal company, you have to take lower of UAD or brought forward business loss. So a normal company, you need to take lower of UAD or the business loss. In case either of it is nil, then allowance is 0 because lower will be 0. But in case of company which has gone for insolvency bankruptcy, it will be aggregate of UAD plus business loss. Fine. Last, income in respect of royalty chargeable under section 115 BBF. 115 BBF is again a concessional rate in respect of royalty in relation to the patents developed and registered in India, which is at 10%. So again, if you charge MAT on it, the benefit of 10% concessional rate will go away. So therefore, they say that less the income, add the expenses. So these are the only adjustments that you will make in the examination when the question comes on MAT. Fine? Any doubt? Any question? Yes or no? Is it clear, students? Fine?
प्रॉब्लम करेंगे कब और क्लैरिटी मिलेगा?
We are going to solve a problem. But before we go on to a problem, let me give you one problem with respect to this particular entire thing. So in examination, see students, the question can come in a very tricky way, wherein they might ask you that the question will say that these are the adjustments that needs to be made to the total income. And the question will just say that compute the tax liability. Now, unless in the examination the question tells you that ignore MAT provision, in case the question is of a company, that means you need to also consider the MAT provision. Unless the examination says that ignore the tax computation under 115 BAA or 115 BAB, that means you still need to consider that. So if in the examination the question comes like that, you have to just compute the tax liability. Are we getting this point? Then that means that you have to consider all the provisions, students. You need to consider the normal provisions. You need to consider the concessional tax rate. You need to also consider the 115 BAA or 115 BAB, whichever may be applicable. Plus, you will also consider the MAT provision, students. Are we getting this particular point? So in examination, unless the question tells you that you ignore the 115 BAA or 115 BAB or 115 JB, you don't need to ignore. So read the exam question very, very carefully until the end. Do not rush in reading the question. Reading of the question is the most important thing, students. If you read it wrong, the marks are gone itself. There only. Are we clear? Any questions? Shall we do one question here?
Yes,
Let
ma'am.
me show the question. Let me give you one question itself. Just one minute. Let me just copy the question here. Is this question visible to you?
No, ma'am.
Okay. Now is it visible?
Yes, ma'am.
Okay. So I have developed one small question. It's a very easy question, but let us see. The ABC Private Limited Company, incorporated on 1st November 2025, is engaged in the manufacturing of footwear and has set up factory in Northeast. It has reported a net profit of 80 lakh for 25-26. The following items are credited or debited to the profit and loss account. Contribution to the research association eligible for deduction under 35(1)(2) of rupees 2 lakh. What will be the impact of this under normal provision? You need to first of all check what is 35(1)(2). Yes, whether this is in-house, whether this is expenses paid outside, what is it? Yes. 35(1)(2) was contribution to association, university, college for scientific research. Whether this is allowed under normal provision?
Yes, ma'am.
Yes, ma'am.
Yes. Fine. So yes, we will allow this under normal provision. So here I am writing normal. Since the question doesn't tell you to ignore 115 BAA or BAB, we have to consider that as well. So here this is allowed. In 115, whether we will go for 115 BAA or BAB?
No, ma'am. It is after BAA it can go, ma'am. BAB it is not possible, ma'am. It is 2025.
Correct. So this is incorporated after 2025. So no 115 BAB, even though it is manufacturing. Right? Now whether this deduction is allowed under this particular?
No, ma'am.
No. Expenses towards in-house R&D of 2 lakh.
Allowed, ma'am. In
Allowed in both the cases.
Correct. Depreciation as per books of accounts.
No, we have to add back.
Yes, sir.
Not allowed. Not allowed. Royalty received from patents developed and registered in India, rupees 10 lakh. Expenses on royalty 1 lakh. So as I told you students that for the royalty received in respect of patents developed and registered in India. So if you go to this section 115BBF, what I was talking to you about, tax on income from patent. It says where the total income of an eligible assessee, who is an eligible assessee? A person resident in India. Any person, it can be company, it can be individual, anyone who is a resident in India, has income by way of royalty in respect of a patent developed and patent registered in India, the income tax will be 10%. And this will be on gross basis, meaning no reduction of any expenditure or allowance shall be given. Right? And if the person has exercised the option of going for this concessional tax of 10% before the due date of return of income. So in case, let's say this person wants to go for this 10% rate, it will be directly 10 lakh, 10%. And this expenditure on royalty will not be allowed. So what you will do is, you will add back the expenses and you will reduce the income because this will be separately taxed at 10%. Clear? Fine. STCG on transfer of listed equity shares on recognized stock exchange 10 lakh.
ma'am, on royalties, under normal also it will be taxed under 115 section only, ma'am. We have
Sorry?
to tax it at under normal provisions also we have to tax it at 10% only, ma'am.
Why?
So, मतलब नॉर्मल प्रोविजंस में अपन किताबों में दिखा के 10 लाख और एक्सपेंडिचर 1 लाख लेके वैसे ही करेंगे और सिर्फ अंडर 115 BA में ही एक्सपेंस को ऐड बैक करके इनकम को लेस करके दिखाएंगे.
No. Normal provision also, this will be treated as a separate income only. No, you will not treat it in the... So it will be a business income. But for the purpose of taxability, you will disallow the expenditure, no?
Okay, ma'am.
Because you want to calculate the tax rate. Now you can't claim the 10% as well as the expense. Either you go for 9 lakh and pay the tax at the rate of 30% or 22%.
Okay, ma'am.
Right? Otherwise, on 10 lakh, you have 10%, which is more beneficial.
Yes,
So
ma'am.
you will add back the expense, right?
Okay.
What about the STCG on transfer of listed equity shares on recognized stock exchange?
Add back, ma'am. Separately shown.
Separately shown. What is the tax rate over here?
It's 20% now.
20% now, correct? So 20%, but what will be the surcharge here if you go for 115 BAA?
10%.
10%. So here it will be 20, but here it will be 20 plus compulsorily 10% surcharge. Clear? Next is the asset acquired and installed or put to use during the previous year. Plant and machinery 1 crore, out of which 20 lakh is paid in cash. So what will be my depreciation?
What 20 lakhs paid in cash is not allowed, ma'am. Greater than 10,000. So it
What
will be
about
not
80
allowed.
lakh?
On 80 lakhs it will be allowed, ma'am. Plant and machine.
We'll assume for more than 180 days at the
180
rate
days.
of 15%.
15%.
What does it come to?
12 lakhs.
This is allowed under both.
Yes, ma'am.
Then what else?
Additional 20% will allowed in normal case.
Correct. So there will be additional depreciation of 20%. What will be 20%?
16 lakhs.
16 lakh.
16 lakhs.
Here it will not be the case. What about building?
10% on board.
10%, what is it?
5 lakhs.
5 lakhs. Both.
Fine. Then the company has employed the new employee to whom salary was paid, pay was debited to P&L account, of which the details are here under. Date of employment is given. This is 1st January 2020. I think here there's some error. This should be 1st January 2024. Whether allowed? For 80 double J double A. Yes.
Ma'am, it's in November,
It is January.
January. It's allowed, ma'am.
1st January 24. But this is pertaining to the last year.
Last year.
Yes, ma'am. Because 240 days are not completed in last year, so this year that deduction will be allowed 30%.
Is it 240 days?
No, 150 days because it is a footwear.
Correct. So here it will be 150 days. So for this, we'll consider 150 days. So last year, even though the employees were not there for 150 days, but if the employees have stayed in the current year for 150 days, so we will allow this. So 2 into 18,000 into how many months? 12 months. Right? We'll allow it for 25-26. We are looking at 25-26, right?
Yes, ma'am.
So, sorry, this should be 25 only. It's not 24. One second. Yes. Then 1st December 2025.
Not allowed, ma'am.
Not allowed?
Less
Why?
than 150 days.
This is less than 150 days. So this is not allowed. What about next one, 28,000 1st January 2025?
Not allowed because it's even less than 150 days. Also, the amount is exceeding 25,000.
Correct. So this is greater than 25,000. This is 28,000 by check. So it is 1st January 2025. You are checking from 1st April 25 to 31st March 26, right? So this is more than 150 days in the current year. In the last year, it was less than 150. In the current year, this is more than 150 days. Right? But the salary is more than 25,000. So that is the reason why this is not allowed.
Right,
Right?
ma'am.
What about the last 25 employees?
Not allowed. Paid via cash.
This
More
is
than
paid in.
10%.
Right? Now what we will do is we will compute here as per the normal provision first. And then we will compare it with the MAT. Then we will compare it with the 115 BAA. Under 115 BAA, MAT is not applicable. Right? So here I am starting with my net profit. What is my net profit? 80 lakh. My book profit is also 80 lakh. Clear? Then Contribution to research association, we said it is allowed under normal, but not under 115 BAA. So, contribution to research association, we will disallow the 2 lakh year under 115 BAA. Fine. Under MAT, it will be allowed. There will not be any adjustment. Expenses towards in-house R&D, this is allowed under both. Under MAT also, there is no impact. Depreciation as per books of accounts. What will it do under MAT? Yes?
Add back.
Add back. Correct. And less, again in the MAT, you will do same 40 lakh. So this is how you need to make the presentation. And in the normal provision, you will do the depreciation as per section 32. What is the depreciation as per 32 under normal provision? 12, 16 and 5. What is the total coming to? 33 lakhs?
33 lakhs.
And here it is 18 lakhs?
17.
17 lakhs.
17 lakhs.
17, sorry, yes. So 33 and 17. Fine. Next is royalty received from patent registered in India. We'll add back the expense. In the MAT, value add back?
No, ma'am.
We will write. That's what we studied. Income in respect of royalty chargeable under 115 BBF. We will add back the expense, reduce the income. Yes or no?
Yes, yes.
We will add back here because there's no point if you are giving the concessional rate and you are subjecting it to MAT, the benefit is gone. Right? Less royalty income. We will reduce under the MAT also. And we will consider it separately for the purposes of tax. Only 10 lakh. Under MAT, I am not considering it. Yes? MAT, I am not considering it. MAT, there is no MAT on this 10 lakh. Yes or no? Yes? Are we clear, students?
Yes, ma'am.
STCG on transfer of listed equity shares. I will reduce. How much is it? Whether I'll reduce it in the MAT? Yes? Whether you'll reduce in the MAT or not?
Yes, ma'am. We'll show it separately in matter.
No. There is no specified adjustment for STCG under the MAT. Do you see any specified adjustment under the MAT?
No, no.
Only the specified adjustments are to be carried out. So on this 10 lakh, it will not be reduced from the MAT. It will be there. Fine?
If it is a foreign company, then only we will.
Correct. If it is a foreign company, then you need to reduce capital gain on securities.
Okay.
Fine?
In that too also the rate is less than 15%.
No. That is only for this thing. Interest, royalty, FTS, dividend.
Okay.
That is not in the case for the capital gain. Fine, because for the capital gain is not taxable under 115A. Fine?
Okay.
Yes or no? Okay? Any questions? Okay. Next is depreciation be considered 80 WGAA. Okay, so first let us compute the PGBP. What is my PGBP here coming to? Calculate please it. Is it coming to 68 lakh?
Yes, ma'am, 68 lakhs.
What about the 115 BAA?
86, ma'am.
All of you getting this answer? Yes?
Yes, ma'am.
Clear? Now, what is my gross total income coming to? 88 lakhs? Yes? And 106 lakh? Yes or no?
Yes,
Okay,
ma'am.
one adjustment we forgot. Wait. The company has employed new employees to whom salary paid was debited to the P&L account. In this case, there is 11,000 paid in cash. Will this be allowed?
No, ma'am. Greater than 10,000 expense is not allowed.
Under which section?
48.
48.
48.3. Yes? 48.3 says expenditure in cash is not allowed more than 10,000. Now this is 11,000 and this is debited to P&L. So what will you do?
Add back.
Add back. So here we have not added back. So your expenditure in cash. How much it will be? 11,000 into 12 months. No, not 12 months. How many months it is? This is 12 months, yeah, because this is employed in February 25. So we are considering from April 25 to March 25. March 26, 25 employees. How much this comes to?
33 lakhs.
33 lakhs. Under MAT, this will be disallowed?
No, ma'am.
Yes?
Nothing specific given there.
Yes. So what is the total income? Sorry, PGBP calculate, please. I think 101 lakh.
101.
Yes.
119. 101 and 119.
And then what is the gross total income? 121 lakhs. Yes.
121, 126 lakhs.
How 126? 119 plus 20.
113.
139, right?
113.
Okay. Then what is your book profit under the MAT? $71?
71.
Okay. Then less chapter 6A 80 double J double A. What is the 80 double J double A coming to? This is into 30%. How much does it come to?
1.296
1.296
lakhs.
Okay. Under 115 B double A it is allowed.
Yes, ma'am.
It
Ma'am,
is allowed.
yes, ma'am.
Yeah. Right. So what is my total income?
One 119.704.
And here
137.704.
what will be my normal tax rate?
Turnover, depending upon the previous year turnover.
It
It
is
is
not given in the question. It is incorporated on only on 111. This is 24, not 25. One second. 24.
25%, ma'am.
Because there is turnover of the previous year 23-24 is 0, right?
Yes, ma'am.
Yes. So this is less than 400 crores. So 25%. Okay, what does it come to?
$29.926.
Is there any surcharge? Yes. 7%, right?
Yes, ma'am.
As total income is
1 crore.
greater than rupees 1 crore. So how much final tax liability comes to after tax, surcharge, cess? How much it comes to?
It's 36.64.
This is the final tax liability? Yes.
Yes, ma'am.
Yes. Fine. What is the tax liability now under MAT?
15%.
Yes. What is it?
10.65.
And 10.65. Is there any surcharge here?
No, ma'am. Plus
No.
plus 4%, sir. Yes.
As my book profits are less than 1 plus my cess of 4%. What is it total coming to?
11.076.
Is my book tax on total income less than the MAT? No, right?
No, ma'am.
So MAT is not applicable. So my comparative shows that what is my tax liability? 36.64 lakh. Fine. Now coming to this particular year, what will be my tax?
22%.
So tax on what is my PGBP year? 119 lakh. What is it coming to?
26.18.
What about 10 lakh? What will be the tax rate on 10 lakh royalty?
10%.
10% because any special income even under 115 BAA is taxable at the specific rate which is provided under the Act. Yes? Yes or no?
Yes,
Yes, ma'am.
This will be 1 lakh. What about STCG?
20%.
20%.
20%. If it would have been STCG in respect of any other depreciable asset, then what would have been the tax rate?
22%.
2%.
22%. Correct? Yes. Here my surcharge is 10% on all the income. Yes. Plus cess at the rate of 4%. So what does my tax liability comes to? 29.18 lakh? Yes. So what is better for the taxpayer between these two options? To opt for 115 B double. So this is how you will do a comparative question. Clear? Any questions, any doubt? Yes or no, students?
No, ma'am.
Fine. So in exam, whenever it is said that don't ignore the 115 BAA, BAB or 115 JB, you need to consider all the three. So be careful in the examination. Fine. Nega, you had a question. An asset is purchased in 23-24 previous year, but it is not put to use in that year. That means we should add the cost of asset to the block of asset in previous year 23-24, but should not charge depreciation for it in that previous year. And if we have put to use an asset in subsequent year, then we can charge full depreciation on that asset in the previous year 24-25. Also, if the asset was an entity eligible SSC was an entity eligible for additional depreciation of 20%, but as of date put to use is in subsequent previous year. Would he be eligible to claim additional depreciation in the previous year in which it is actually put to use, that is 24-25? Yes. You're right, Megha. You will charge the depreciation in the year in which it is put to use. Megha, in the exam, do you do this by this preparing column and giving final conclusion? No. You have to prepare 3 proper this thing computations and then conclude it by giving a solution in the final summary. So do it in a very systematic way so that the examiner is able to check. Here we have done it for the purpose because we have lesser time in hand. So we have done it for the presentation in this way. For the exam, you have to do the proper full-fledged presentation. Any other questions, students, before we close the session?
मैम 80 डबल जे डबल ए का डिडक्शन कहाँ पे लिए मैम 1.296 lakhs
मिला ना यहाँ पर?
but while calculation of the tax
हाँ.
we have taken directly tax on 119 lakh
So
139
this 121 minus 1.29 is 119, na? This is my GTI, this is my deduction, and this is my total income.
okay 101
Huh?
okay
121 is my GTI, and out of that 1.296 is my 80 double G double A. Out of that, I have got the total income is 119, which is after the deduction.
while calculation of the tax amount जब calculate कर रहे हैं
Okay. Got it. Yes, very important. Yes. So here we have taken 101, you are saying.
yes ma'am.
Yeah, this is a mistake that we have done. Yes, see, in the examination also, if we are making a mistake here, in the examination, we can surely make it. So this should be 101 minus 1.296 lakh, right?
Yes ma'am.
So this should be 99.704.
Yes ma'am.
Right? On that 20. Yes, so this will entirely change. This will be 24.926 plus 3 lakh plus 7% and plus 4%. So this will come to
31.08.
08 lakh. And this comes to 31.08 lakh as well. And here also we need to do it 119. This is 119 minus 1.296.
117.70.
So this will be coming to 25.90 or 25.89 lakh. Plus 3 lakh plus 10% and plus 4%. So yes, this in fact is going high, isn't it?
33.05.
Yeah.
06.
So small mistake can make the entire answer go wrong. Yes or no? So
Yes,
here
ma'am.
the answer changes to opt for normal tax provision. Thank you so much for highlighting. Is it clear, students? Did you understand what is the mistake that we made? Yes? Okay.
Yes ma'am. Clear ma'am.
Okay. So let us stop over here. We meet in the next class. Thank you so much.
Thank you, ma'am.
Thank you. Yes.